Rolex sell their watches through authorized dealers. The dealer gets a small allocation of the watches. A Daytona, a Pepsi GMT, a Steel Submariner, maybe one or two a year. And they have hundreds of customers who want the same thing. So who gets it? You walking in today with cash and asked for a Daytona, you would leave without it. Not because Rolex cannot produce one. In 2024, they made 64,000 fewer watches than the year before and generated $480 million more in revenue. In 2025, output fell again. Revenue rose again. Rolex began as a distribution business, not a manufacturer. Hans Wilsdorf and Alfred Davis founded Wilsdorf and Davis in London in 1905 to import Swiss movements, place them in English cases and sell them to jewelers who put their own names on the dials. By the 1970s, Rolex operated inside an industry employing approximately 90,000 workers across approximately 1,600 Swiss watch companies. Within a decade, that industry was in structural collapse. Swiss watchmakers fell to under 600 companies by the mid-1980s. Employment across the industry dropped to 33,000 over the same period. While competitors abandoned mechanical movements for quartz electronics, Rolex stayed largely mechanical, raised prices, tightened distribution, and repositioned its watches not as timekeeping instruments, but as marks of professional achievement. A Rolex was no longer a precision tool. It was evidence of what the person wearing it had built. The brand limited access to its most desirable references to authorized dealers operating under strict distribution terms, concentrated production on models that carried the highest prestige signal, and marketed ownership as accomplishment rather than consumption. By the time the crisis ended, Rolex competed not on accuracy or price, but on what owning one meant. The distribution system built over the following decades is the infrastructure that makes the current pricing architecture possible. Rolex does not own its retail network. It operates through approximately 1,816 authorized dealers in 118 countries, independent companies that have signed a formal distribution agreement with Rolex SA. The terms of that agreement, on public record via SEC filings, are precise and one-sided. Authorized dealers sell only to end consumers at retail price, over the counter, at their authorized locations. They cannot act as wholesalers, cannot transship stock to other dealers, and must purchase whatever allocation Rolex sends them, regardless of whether they have customers waiting for those specific references. The gross margin for an authorized dealer is approximately 40%, buying at 40% below recommended retail price before rent, staff, and operating costs. Allocation is set entirely by Rolex. Dealers receive what Rolex sends and cannot order the specific references their customers want. On the most coveted references, a dealer may receive 1 or 2 units per year, while the demand from that dealer's customer base runs considerably higher. The gap between what arrives and what customers want is the dealer's problem to manage. The practice that has emerged from that gap is not dictated by any documented Rolex policy, but it has become broadly consistent across the network. Allocation of sought-after references goes to customers with purchase history, weighted by spend rather than time on a list. Customers who have bought other Rolex references, jewelry or watches from partner brands at full retail, receive priority. In practice, a customer pursuing a steel Daytona may spend years buying other watches and jewelry at full retail, building the commercial relationship that earns consideration when an allocation arrives. A customer who walks in without history will not receive one. The structural condition that makes this entire architecture sustainable is the Hans Wilsdorf Foundation, established in 1945 and holding 100% ownership of Rolex SA since 1960. The foundation has no shareholders and no external investors. It carries no obligation to deliver quarterly returns to any outside party and pays a lower tax rate as a registered Swiss charitable foundation. A publicly traded luxury company, faces investor pressure to close the gap between retail and market price, and to extract maximum revenue from every point of excess demand. Rolex has faced none of that pressure since 1960. In the 1990s, a customer could walk into an authorized Rolex dealer and leave with a steel Submariner at list price, sometimes at a discount. That changed as demand grew through the late 1990s and accelerated sharply after 2019. The watches customers wanted were not on the shelf. Dealers offered to add names to lists. The lists offered no guarantee of timeline or allocation. Demand had grown beyond what the authorized network was calibrated to manage, and the grey market that had always operated at the margins of the authorized channel moved to the center of the conversation about how to actually buy a Rolex. Grey market dealers are not counterfeit operators. They are authentic watch dealers who source from private sellers and estates, operating legally outside the authorized distribution network at prices set by supply and demand rather than Rolex's retail schedule. In 2020, a stainless steel Daytona, retailing at approximately $15,000, was trading on the open secondary market for $30,000. By March 2022, the grey market index for Rolex had reached approximately $17,206 as an average across the entire range, and the Daytona was trading above $50,000. Rolex was producing approximately 1,240,000 watches per year at the peak of that demand surge. Over a quarter of that production went into Datejusts, 328,800 units in 2024 alone, a reference that dealers could place without a waitlist. The Daytona represented approximately 10% of total production, around 100 to 120,000 watches distributed across 1,816 dealers in 118 countries, which is exactly why a dealer receiving single-digit annual allocations had no mechanism to satisfy every customer requesting one. Rolex's official response to questions about the shortage was direct.
The scarcity of its products was not a strategy, and current production could not meet demand without reducing quality, which the brand refused to do.
The production data from the years immediately following that statement sits in direct tension with it. In 2024, Rolex reduced production from 1,240,000 watches to 1,176,000, 64,000 fewer units, in a year when grey market premiums on steel sports references persisted well above retail. In 2025, Rolex cut production again to approximately 1,100,000 watches. Swiss bank Vontobel tracked the second consecutive reduction through retail data and company filings, and the figure was reported by Hodinkee. Rolex made no public announcement. Simultaneously, Rolex broke ground on the Bulle facility, a 1 billion Swiss franc factory with a planned workforce of 2,000 people, not expected to reach full operation until 2029. In early 2025, the brand activated 2 temporary production sites in Romont and Villaz-Saint-Pierre, employing between 250 and 300 skilled workers as short-term tactical capacity. A long-term production expansion and 2 consecutive short-term production cuts are not the combination a brand genuinely constrained by its manufacturing ceiling would pursue at the same time. The grey market correction arrived in mid-2022 when rising interest rates and the collapse of cryptocurrency values removed a significant portion of speculative demand from secondary markets. The Daytona fell from above $50,000. The grey market index dropped from approximately $17,206 at peak to approximately $11,785 by December 2022. By 2025, the premium on steel sports references had compressed to a range of approximately 10 to 50% above retail, down from peaks of 87 to 145% during the boom. The premium did not reach zero. A steel Daytona at $16,900 continued trading above retail on the open secondary market through 2025. A Submariner date at $10,400 continued attracting buyers willing to pay above list. 2 consecutive production cuts did not close the gap between what Rolex charges through its authorized network and what the secondary market pays for the same references. The production data raises a question the official scarcity statement does not answer. Rolex's wholesale revenue in 2024 was 10.58 billion Swiss francs. It came from 1,176,000 watches. In 2023, revenue was 10.1 billion Swiss francs from 1,240,000 watches. The brand produced 64,000 fewer watches. Revenue grew by 480 million Swiss francs. In 2025, output fell for the second consecutive year, and revenue rose for the second consecutive year, reaching approximately 11 billion Swiss francs from approximately 1,100,000 watches. The direction of those two figures across 2 years is the data. The average wholesale price per watch climbed from 11,500 Swiss francs in 2021 to 13,140 Swiss francs in 2024, an increase of 1,640 Swiss francs per unit, multiplied across 1,176,000 units. That increase in average price generated approximately 1.93 billion Swiss francs in additional revenue relative to 2021 pricing. Rolex did not achieve this by raising retail prices on its most coveted references proportionally to what the secondary market would clear. It achieved it by shifting production composition toward higher value configurations while holding supply constrained on the references that generate the brand's desirability signal. The grey market premium that persists on steel sports references is a gap Rolex does not capture. Rolex sells to an authorized dealer at approximately 40% below retail. The dealer captures the gross margin on the retail transaction. Any premium above retail that the secondary market generates is captured by whoever holds the watch outside the authorized channel. Rolex receives none of it. The foundation structure means no shareholder can demand it close that gap by raising retail. And the gap itself, the publicly observable fact that a Daytona trades at a premium the day it leaves an authorized dealer, is the signal that tells every prospective buyer the retail price is already a discount. A brand that raised its Daytona retail price to match the secondary market would capture the premium it currently leaves on the table. It would also eliminate the premium, the signal that the watch is scarce, that retail access is a discount available only to the most connected buyers, that the grey market exists because authorized supply does not reach everyone who wants the watch. All of that collapses when retail price meets secondary market price. The scarcity signal functions only when the product is genuinely scarce at the price being charged. Rolex cannot manufacture that signal by raising prices. It can only sustain it by not raising them. The authorized dealers who manage the waitlists, who allocate scarce references to customers with purchase histories, who field inquiries from customers on lists carrying no guarantee and no timeline, they perform that function at their own cost. The distribution agreement requires them to buy whatever Rolex sends, sell only at retail, and absorb the operational cost of maintaining customer relationships that may extend years before an allocation arrives. The dealer is an unpaid administrator of a scarcity mechanism from which Rolex derives the primary financial benefit. The irony is that the waitlist is not a symptom of demand Rolex cannot satisfy. It is the product that demand is purchasing. The watch is what the buyer receives. The years of purchase history, the relationship with the authorized dealer, the grey market premium that validates the retail access as a discount worth earning. That is what the architecture sells. The foundation structure removes all pressure to close the retail to grey gap. The distribution agreement turns every authorized dealer into a supply administrator at no direct cost to Rolex. The production decisions cut output 2 years running while revenue grew both years. Each is a component of the same system. Rolex held 57% of Swiss watch sales above 3,000 Swiss francs by value in 2023. By 2025, with 2 consecutive production cuts behind it, that figure was 61%. Rolex generated 11 billion Swiss francs in wholesale revenue in 2025, representing an estimated retail value of 16 billion Swiss francs and 33% of the entire luxury watch market, from approximately 1,100,000 watches. That was the second consecutive annual production cut. Over the same 2-year period, market share of Swiss watches priced above 3,000 Swiss francs grew from 57% to 61%, while output fell. The grey market correction of 2022 was the most significant stress test the architecture had faced. The Daytona fell from above $50,000 at peak. The grey market index dropped from approximately $17,206 to approximately $11,785 by December 2022, and speculative buyers who had entered during the pandemic demand surge exited. Rolex did not respond by closing the retail to grey gap. It built a mechanism to begin recapturing the revenue the gap had always routed outside the authorized channel. In December 2022, at the bottom of the correction, Rolex launched its Certified Pre-Owned program, enabling authorized dealers to sell authenticated second-hand watches with a 2-year manufacturer guarantee. The program generated approximately $90 million in its first full year. By 2024, that figure had grown to approximately $300 million. In 2025, it reached $594 million, accounting for more than 10% of the total secondary market for Rolex watches, estimated at approximately $7 billion for the year. CPO watches commanded approximately a 30% premium above equivalent grey market listings. In May 2025, Rolex lowered the program's eligibility age from 3 years to 2, expanding the supply base and the revenue capture at the same time. The Bulle factory, 1 billion Swiss francs, 2,000 workers, full operation scheduled for 2029, will add capacity the current architecture does not require to generate the results it is already producing. 2 consecutive production cuts with revenue growth in both years describes a system operating as intended. From $90 million in 2023 to $594 million in 2025, Rolex built an entire secondary market business without manufacturing a single additional watch to create it. When the Bulle factory opens and additional capacity exists, do you think the waitlist survives, or does the architecture require the constraint to function? Let us know in the comments. Next week, I will cover much in-depth story about the 3 brands that races on 1969's chronograph war. Follow this channel and I'll see you on the next video.